Hello, everyone, and welcome to our webinar today. I'm really excited everybody could join us. We are doing, again, some fancy slides for the second week in a row. Typically, this is our private training just for our partners, but we have so many of you that are loan brokers that we're doing this for you. And we also have some other loan brokers that are not part of this group that we promise to get some training to on this topic as well. So we will probably share it. So you get the reward of really cool, fancy slides. So yesterday we talked a little bit, or last week we talked a little bit about three different ways that we can get loans or financing for our customers based on what I call the 3C's formula to lending. And although I should probably think of a much prettier and better name, it really does sum it up pretty well. And what it really comes down to is this: in order for a borrower to get a business loan, they either need to get, or a credit line, they either need to have good consumer credit, collateral, or cash flow, or good business credit as well. We'll talk about that. So we've talked about cash flow financing, all the kind of financing that's available for borrowers based on them having consistent cash flow. Today, we dive into the second C, credit. We talk about the financing that's available for credit. Now, I'm going to talk a little bit more about startup financing today as well, because again, even though credit doesn't necessarily mean startup, a lot of times the financing that's available based on credit is really relatable to startups. And then next week, we'll be talking about collateral-based financing. Now, remember, the beautiful thing about the 3C's formula is you only need one and no more. If you have one, the other two don't matter. So last week we talked about cash flow financing and how you could get a lot of that regardless of credit or collateral. Today we're going to talk about financing you can get based on credit, where a lot of it you can get regardless of cash flow or collateral. And then next week we'll talk about using collateral where credit and cash flow don't matter. And this is why I say a lot of the financing we're going to talk about today is very, very obtainable for startups, because startups don't have cash flow. So because startups don't have cash flow, anything that we do talking about credit-based financing or collateral-based financing will typically work for them because they don't have cash flow. So therefore, they need financing that uses one of these other C's for approval. So again, even though credit won't tie into the very ones we'll end up to today talking about startups, it's still applicable because a lot of people that are looking for this C are doing so because they don't have cash flow, which usually means they're in a more of a startup phase. So today, let's dive in. Let's talk a little bit more about financing that's based on credit. And then hopefully here, I don't have a bunch of that, which I do. So give me 1 second here. I'm going to go through and make sure that I don't let me look at this really quick here, make sure my slides are lined, are set up the way that they need to be. Okay, I think I'm good. It's just that was kind of a weird thing because I didn't have animations on some of my slides. So, okay, so we are good to go. All right, so cash flow, credit, and collateral. Today we're diving into credit. So unsecured business financing, startup financing, credit card stacking. This is the most popular form of financing based on the C. As a matter of fact, this will really be the only one that's only based on credit. The others will take probably some cash flow into effect that we'll talk about. So we'll talk about several different options here. So we call this unsecured business financing, UBF. It's also known as startup financing. It's also often known as credit card stacking. Now, this typically requires 650 plus consumer credit scores for what are called consumer or standard credit cards. Those are credit cards that report to the consumer or personal reporting agencies. And 680 plus FICO scores usually gets us the business cards. These are cards that report to the business reporting agencies. It's about the only difference. We're going to talk about both programs, but for the most part, the biggest difference between these two is the fact that you can get a lower score, easier to qualify with the standard cards, and with the 680 plus, you need better credit, but these will help you build business credit at the same time, as we'll talk about. So let's talk about the personal first. So you get approvals from 10,000 to 150,000 in total funding. Usually what happens is this: we are working with finance sources. I can't call them lenders and I can't call them credit issuers because they do neither. These are experts in these kind of credit cards that require personal credit checks. Okay, so I will often tell people, look, Our expertise is in the world where you're getting corporate business credit cards, no credit check, no personal guarantee. This world is a world where you are providing guarantees, you are providing personal credit checks, but in doing so, you're able to get credit lines through stacking credit cards. You're getting a multitude of different credit cards. So approval amounts are equal currently to about 5 times the limit of your existing account. It's usually about 5 to 8 times. What do I mean by that? I mean, if your highest credit limit account you have now is 10 grand, you're usually able to get about 5 to 8 times that in financing, which is $50,000 to $80,000 in financing. And they do this through 5 to 8 individual credit cards, credit lines, kind of a hybrid in between the two, and I'll tell you why here in just a minute. If inquiries and utilization are low, they're typically able to get 5 to 8 times the amount of their highest credit limit through 5 to 8 types of accounts. Now, these report to the consumer credit reporting agencies. Now, typically, somebody may get both. They're typically offered that they can get standard cards and business cards at the same time. All the lenders, or I shouldn't say lenders, all the finance sources in this space who specialize in getting these kind of accounts, they basically will give an approval for somebody for the most amount of money they can get, consumer and business cards. They'll have a separate place on the approval that says if you just want business cards, here's how much you can get. And sometimes people can't get any business credit cards because their credit's not good enough and they can only get these consumer cards, which report to the consumer reporting agencies. Now, again, they get up to 5 cards, so it creates competition. This is the way credit issuers work, right? So my wife and I just had this exact same thing happen. We use American Express as our primary consumer credit card, and then we're like, look, we need a Visa because we have places that will only accept Visa, and apparently all we had was Amex and MasterCards. So we went and got a Visa, and the Visa was like double the highest limit card that we'd ever had. So we immediately started using that card for all of our expenses. Within weeks, American Express realized what we were doing, and they immediately sent us a notice, and they doubled our credit limit, unsolicited, never asked them. Their system indicated that we stopped using the card as much, and they immediately saw that we had a new card with a much higher limit. They immediately mimicked that limit and gave us that similar limit. So this is what happens when you have credit cards, multiple credit cards, you create competition where one of them doesn't want you using the other one. They want to be your primary one. So what they do is they continue to raise your limits so they could be your highest limited account, because most of us carry our highest limit account with us at any given time. So that's why having multiple accounts is a huge benefit, because it creates this competition. Now, on these kind of accounts, you can usually get normal 0% intro rates. That usually goes for about 6 to 18 months. And some sources will help you turn around and get more credit cards at this time so you can continue that 0%. I'm a big fan of loyalty. If they gave you 0% for 6 to 18 months and made no money on you, then give them a chance to make money as it converts to a regular credit card and use it accordingly. Okay, you're going to pay normal rates out of after that of 5 to 25%, of course, depending on the card risk, etc. Now, most lenders in this space charge a 10 to 12% success-based fee. So what that means if you get $100,000 in funding, the total fee to you is going to be $10,000, that's 10%, or $12,000, that's 12%, depending on the lender or the finance source, and they roll that right into the cards you get. Just like an SBA loan, where we're used to our borrowers' fees getting rolled into the loan, it's the same thing here. The lender's just rolling the fee, the finance source is rolling the fee in, and they just put the fee on the card. They let you put the fee that you get on the card that you actually got issued to you. So you don't pay unless you actually get the result. Okay, now on our end, we're closer to the 10% range because we get a discount from our lenders because we do so much volume, but it's not uncommon to see a lot of the finance sources out there charging the higher end of that, of the 12% success-based fee. And as brokers, what they pay wildly varies too, based on volume, et cetera, of how much you can actually earn on this kind of financing. Now, you'll need 650 plus credit scores for a borrower to get approved. Utilization has to be under 50%, sometimes under 60%. You can even still get some cards, much higher than we're going to find on the next type of account. Less than 8 inquiries on the report in the last 6 months, and one of the best ways to get a high amount of money when they have no collateral or cash flow. This is the highest approvals I've ever seen for startup, period. I don't know of any other kind of financing a startup can get with higher approvals unless it's equity financing, unless you're going for stuff like angel investors. So it works for even a startup, as we mentioned. And again, it can pay you 2-3 points, maybe even more, depending on the finance source. So second program. Now, very similar to what we just talked about, but the program we just talked about, they're getting up to 5 credit cards that they can use. Now, I call them hybrids. And here's why, because as we talked about, these are credit cards. Credit cards give you the benefit. Let me see here if I go back. Credit cards give you the benefit of this, 0% interest rates. Credit lines don't do this. Consumer and business, if you get a credit line, you start paying interest on the credit line right away. One of the huge benefits of credit cards is that you can get these 0% interest rates for credit 6 to 18 months. One of the benefits of credit lines is that you could take the cash out without paying a cash advance interest rate. Cash advance interest rates on credit cards are like 22%. With these programs, both personal and business, the finance source helps you get both the 0% rate, the benefit of the card, and take the cash out, the benefit of the line. So the borrower gets the benefit of both 0% and a credit line while creating competition and all these other benefits. Now, what I just told you about was business reporting. These accounts are also 10 to 150,000 on average. Now, again, if the higher limits you have determine where you are here. If your credit limit on your highest limit credit card is 20 grand, then that means you're going to get a lot more money than the person that has a credit limit of 10 grand, for example, because you're usually going to get 5 to 8 times that amount. Now, again, approval amounts are equivalent to 5 to 8 times the limit because you're getting 5 to 8 cards. Usually on the business side, you're usually getting 5 is what you'll see. And anything above that are usually in consumer cards. And again, the borrowers can choose. You'll get an approval from the finance source. And the finance source will say, okay, look, here you go. Here's personal and business cards, average of what we can get. Here's an estimate of what we can get if it's just business cards. So they'll be able to choose which of those they want. These reports are the business credit reporting agency. So this has to be one of my absolute favorite funding products of all time because somebody can get $50,000 to $150,000 on average in money they could use, 0% cash out ability. And then these accounts, they get these 5 accounts plus they get report to the business credit reporting agencies. So not only are they getting the money they need, they're building business credit at the same time. And as we remember here, once they build 5 accounts on their business credit reports, then they can immediately start getting revolving store credit. Staples, Office Depot, Sam's Club, Costco, Amazon, Best Buy, these start to become available once somebody gets 5 accounts on their business credit reports. So by this, they're putting not only just 5 accounts on their business credit reports, they're putting 5 really high limit accounts on the business credit reports. So it really jump starts the business credit building because instead of getting a $1,000 limit vendor credit with Uline or Quill, they're getting a $5,000, $10,000, $20,000 limit account with Visa that reports on the business credit reports. So it helps them get credit much faster and much higher limits on the future credit they get, the store credit that they tend to get or that they'll get next. And they get money and build their business credit at the same time, which is why I love that. Again, they're creating competition. The benefit here is that when the one has the highest limit, then they're typically going to want to be the primary card. So we have this all the time. And if you don't do this now, you should advise your borrowers as well that every 6 months you should call every credit issuer and ask for a credit limit increase. I do this if they don't pull my personal credit. If they tell me they're going to need to pull my personal credit, I won't let them do it. The reason for that is because I know that if I use my personal credit inquiry to get a new card, I could get substantially more money than them just raising my limit. So if I'm going to use my inquiry, I'm going to use it wisely, and you should advise all of your clients to do the same because inquiries matter so much, especially when it comes to this kind of financing. So it creates competition, which helps them get limit increases because each credit issuer is trying to mimic the highest limit account that somebody has. Again, 0% interest rates for 6 to 18 months. And again, normal credit card interest rates after that. Now, 10 to 12% success fee rolled into the transaction. They're going to need a 680 plus FICO score. Look, this isn't credit driven, score driven. It's credit driven. So it's based on credit quality, not based on 680. What they're really looking for here is utilization under 30%. Notice on personal cards, I said you could go as high as 50 or 60%. On personal cards, I said you could go as low as 650 scores. So if the borrower's willing to get some accounts that report on their personal credit report, it's going to be much easier for them to get the consumer accounts that report versus these. They're going to need less than 4 inquiries in the last 6 months, maybe 6. But the more inquiries they have, the less approvals they're going to get. So if you bring somebody in with 3 or 4 inquiries, they may only get 3 cards or 4 cards instead of 5. If you have somebody that only has 0 inquiries, they may get 5 to 8 cards. So they're going to get more money the less inquiries they have. This is a really big deal and something that you need to be aware of. Inquiries, especially with this program, are a really big deal. This is why we need to advise our borrowers to not use their personal credit for inquiries unless they absolutely have to. It's such a big deal that in my world, I had this happen the other day where somebody asked me why I have all these authorized user credit cards on my credit report, and I hadn't thought about it. And I looked at my credit report and I realized that it's because my wife has all of our revolving credit in her name, and I don't, because I save my inquiries for the business. On these kind of accounts, if I want them, I know how valuable inquiries are, so I save my inquiries for the business, and any kind of revolving credit we do in my business name with me as the authorized user. That's what we do because we understand the value of inquiries. Hey, we just bought my wife a car. Everything was in her name because I don't want the inquiry on my credit report. Inquiries are a really big deal. And I can tell you that working with financial services, you need to let your borrowers know this because it can cost them a lot of money if they don't get the value of those. And they're starting to use consumer credit to do what they could easily use business credit for and avoid the increase. So this is, again, one of the best ways to get the highest amount of money with no cash flow or cash flow collateral, especially as a startup. And again, as I mentioned, they could do the cash out capability, which means they could liquidate the cards. Okay, that allows them to take the cash out of the cards without paying 20%. They can even do so at 0%. Huge benefit. Some finance sources don't do this that offer the program. Some do, so that's something that you need to be aware of. Rapid rescore. Some of the sources will do a rapid rescore. What they'll do is if the utilization is too high, then they'll let the borrower pay down those credit cards, supply a letter from the credit issuer showing the balance is paid down, and they go right to the credit bureaus and do a rapid rescore to have the credit profile and score updated without waiting a month or 2 months with that new balance and with the new score, which helps them get approved. Okay, loans are available for balance pay downs. Well, so a lot of the finance sources or some of the sources that offer this kind of financing are now offering loans to pay down the credit cards. So if the utilization is 40% and needs to be below 30%, they'll loan the $5,000 to the borrower to pay down the credit card. And so then that way the person can qualify. So these are all unique features that only some finance sources in this space do. Soft pulls. So a lot of sources will have you sign up for credit monitoring and get credit monitoring details. More sources are getting the ability to do soft pulls with the credit bureaus themselves as well. And typically somebody's going to get 5 times more money than they'll get on their own. Look, I have people that come in and don't want to pay the fee, our clients. And we had one guy in particular that had an 800 plus credit score and didn't want to pay the fee. He goes, I'm not paying 10% to get credit cards. I'll do it on my own. We said, okay, let us help. We'll help. Here's everything you're going to need. Here's what the bank's going to require. Tax returns. We helped him get everything together. He went to his bank. He took all of his stuff in there. He walked out with $12,500 in funding, and we had him pre-approved for $75,000 in funding with the program. Very typical. Every example we've looked at like this, the borrower ends up with a fifth as much money as they would have got on their own. And the reason for this is because somebody may think, well, okay, I'll just go get my own credit cards. A lot of problems there. One, do the credit cards report to the consumer or business reporting agencies? Most don't even know that. Okay. The second problem is are you choosing the cards that are going to give you the most points? Are you choosing the cards that are going to give you the longest term on the 0%? Are you choosing the cards that will give you that will give you the best terms? Are you choosing the cards that only report to the business reporting agencies? Are you able to liquidate the cards and pull the cash out? These are things that most people will never successfully do on their own. As a matter of fact, when I talk about business credit building all over the country, this is a common question I get. How do I know if I have business credit cards or not? If you ask that question, you don't have real business credit cards. You provided a guarantee and credit check, or you would know. So again, the purpose here is that we can get somebody a lot more money than they're able to get on their own. And the finance source is getting somebody with the ability to liquidate the credit cards, get the 0%, treat them as credit lines as well, build the business credit, just too many benefits that the borrower wouldn't be able to do on their own. And guarantors are welcome. So if you have somebody that doesn't have good credit, but they have a guarantor, well, then that person can sign as the guarantor and get financing. Now, this is possible with personal and business cards, by the way, but it's especially beneficial on the business cards, because on the business cards, the credit reports are the business reporting agencies. So that means dad can sign as your guarantor. None of the credit shows on his credit report. It all builds the business's credit report. And dad only really has issues if you default on that credit. So guarantors are welcome on both programs, the consumer and the business program as well. So again, one of those things that could be hugely beneficial here, because what you're talking about is being able to even not have good personal credit and still be able to come in and be able to qualify using that as a guarantor. And this is one of the things that you look at, because when it comes to getting the most financing for a borrower, one simple question of do you have a guarantor or not makes all the difference. If we're talking to somebody, we need to make sure, do you have mom, dad, grandpa, grandma, friend, family member that might sign as a guarantor? Why is this important? Because 75% statistically of business owners, 75%, 3 out of 4 you talk to are getting money from family and friends. So if you don't want to ask them about a guarantor because you're like, man, I wouldn't get money from my dad, he's not going to want to either, I don't want to ask him, you're wrong. 75% of them, 3 out of 4, are asking family and friends for money. But here's the deal. If I'm going to go to my dad to get money, it's much easier to go to dad and have him signed as a guarantor to get me $20,000 worth of credit that builds my business credit and doesn't report on his personal credit report than it is for him to pull $20,000 out of his stocks and give it to me, right? So the bottom line is that it's easier to get money from guarantors with using this kind of financing than it is to get physical cash from them. So it opens up a really cool way for people to get money even if they don't have the credit using guarantors. Now, corporate credit cards. Well, customers can build their business credit, then use that established business credit to qualify for Visa, MasterCard, cash credit cards as well. But this kind of credit they can get without the personal guarantee, without the consumer credit check. Now, as loan brokers, there's no money to be made here. Of course, if you're, our partner and you're selling business credit with us, then of course you make money, but there's no service where these credit cards are going to pay you. But it's still a great way to go, because based on established business credit and business credit alone, somebody can get money. Collateral doesn't matter. Cash flow doesn't matter. Personal credit doesn't matter. You're building a small credit profile for the business and using that for the business to fund itself to get the 10, 20, 30, 40, $50,000 individual limit accounts. Now, what I like about this option is you really don't need any of the C's. You don't need collateral, you don't need cash flow, and you don't need good consumer credit either. All you need to do is establish initial business credit, then you're able to get that credit through. So you start, of course, with vendor credit accounts. You move to retail credit once you have about 5 accounts on the credit report: the Sam's Club, the Costco, the BP, the Chevron, the Best Buy. Cash credit, this is the Visa card, this is the MasterCard, the auto vehicle financing. When about 14 accounts are reporting to Dun & Bradstreet, Equifax, Experian, amongst those 3, then you can move to that final tier, and it's based on business credit quality only. So again, we talked about a few different options here. Somebody with average credit can get those consumer credit card UBF program. They can get the UBF program if they have business credit, better scores, and get business credit using a personal guarantee and a credit check. Now we've talked about a third option here where they're using business credit. They're building business credit through vendor accounts. Then they're able to come in through those vendor accounts and they're able to get an initial credit profile and score, and then use that to get high limit revolving credit, even cash credit without the guarantee and credit check. Now, that being said, let's jump into some stuff we did touch upon last week, because I'm not going to spend a bunch of time with these options, but I will go through them because personal credit does matter. You do need an average credit score of about 650 or higher to get these, but you're also going to need revenue to get these. So according to Forbes, peer-to-peer lending, new method of debt financing that allows people to borrow and lend money without a financial institution, harnessing tech and big data. P2B platforms connect borrowers to investors faster, cheaper than any bank. Okay, Prosper, Lending Club, Upstart, Funding Circle, Street Shares. These are all the big players in that space. Lenders will have their own credit score that looks at your likelihood of defaulting over going late over 60 days in a 12-month period. They're also pulling your consumer credit, and you have to have average or better credit to be able to get approved. So they're looking at these other factors to determine approval: revenue, profits, debt to income ratios, consumer credit scores. Okay, fees range from 0.5% to 10%, range loans terms from 1 to 5 years, loan amounts from $25,000 to $500,000. So I bring in peer-to-peer lending into this discussion because yes, you do need revenue and cash flow to get this. So if we look at this 3C's formula, I'm going to go back here a lot. If we look, I don't even, yeah, I'm going to go back. If we look at the 3C's formula here, what we see is this: if you have one of the C's, you can get financing. We just talked about three ways you could use personal or business credit alone to get financing. No cash flow, no collateral. The more C's you have, the more money you can get. So now we're looking at some scenarios where if you had the first two, some cash flow and some credit, two of the 3C's, you're able to get approved. And of course, if you had all 3C's, then you'd be moving to an SBA loan. So term loans, 625 FICO required, about a 650 on average is typically what we see, and good credit score 700 plus is really what's preferred. They got to be in business a year. They've got to have some revenue, 10-month in revenue, tax returns to show a profit. Basically, good credit and financials are what's looked at here. So we've got two of the 3C's. Okay. Now there are some available without tax returns, so with just bank statements that they'll look at. Loan terms can go pretty long on this, depending on the loan amount. When loans are available in the millions, 8 to 15% rate. So pretty typical to what we'd even see with SBA loans here. And new sources, some of them are lending from 500,000 to 15 million. Qualification based on the business merit. Can the business pay its bills? Consumer credit quality, right? Credit, cash flow, some bank account management. So again, we're looking at both of those C's. We're looking at two of the 3C's with cash flow and credit, not just cash flow. Same with SBA loans. You're going to need 2 to 3 years tax returns, P&L's balance sheet, personal and business bank statements, collateral in this case, positive financials, okay? But with all three of the C's and good personal credit, okay, good business credit, and good bank credit, meaning they have at least $10,000 in their bank account or more, with good credit across the board, you can get approved. So this is definitely all 3C's. You need cash flow, credit, and collateral to get to this point. But when it comes to credit, this one's unique because SBA requires good across all three: consumer, business, and bank credit. Now, business credit is sometimes used with cash flow lenders. Sometimes cash flow lenders look at this, but all the big banks look at it. You can't get it. You can't get financing unless you have it. And bank credit comes into play. Bank credit only ever comes into play if you're dealing with the big banks, the big conventional banks, Bank of America, Chase, for example. This is where bank credit comes into play. And if you're not familiar with it, bank credit is a credit score that is based in the banking system. It's based on your ability to borrow within the banking system. You'll never know your bank credit score. They'll never tell you what it is. And I've got training on our YouTube channel about it, but it really comes down to this. You need to have a low, medium, or low, mid, or high 5 rating. And the amount of money you can keep in your bank account over a 90-day period to get a low 5 rating is 10 grand. So you really want to have 10, preferably 70,000 or higher in your bank account on average in the last 90 days to get a good bank credit score. Again, you only ever care about that with SBA loans. So SBA's cap lines, that's their umbrella program for their cap lines, for their credit lines, up to about 5 million, same qualifications that we already talked about. A couple different lines here. A seasonal line is for seasonal businesses, businesses that are busy sometimes of the year and not others. Contract line has to do with direct labor, material costs, very popular for contractors that work for construction projects that wait sometimes many months to get paid. A builder's line, again, for for general contractors or builders. They're building homes, they're doing the work, they're not getting paid for many, many months. So that's what builders lines for. And a standard asset-based line and a small asset-based line. The small asset-based line is the same as the standard, just a little bit less. And this is usually for people that are converting short-term assets into cash. Okay, that's ultimately what's happening. Is these are people that are basically letting people pay them on terms, and they need money in the interim that they're waiting for those payments to come in. So let's look at some other options for startups. And for the record, we're going to wrap up early today. This is not going to be an hour because there's so few options that are based on credit that I almost have to add some of the stuff in, because again, the main programs are using business credit, using the consumer credit to get the consumer cards through a finance source that can get you the most money, and using the business cards. Those are the main that are strictly based on credit, as you're seeing a lot of the other ones will use 2 or 3 of the C's. So let's talk about some other options for startups. Grants. HUD offers them. USDA offers them. Okay, you can also get some from your town, your city, your state, your local area, certain neighborhoods if you're building businesses there. Grants are free money. So you as brokers, we don't make any money on this, but it doesn't matter if we make money or not. Look, there's a lot of kind of financing that we'll even talk about next week that we don't get paid on, but it doesn't matter. You need to do what's best for your borrower. And if telling them about PayPal and Square and having them start running some transactions through there so they can get a PayPal and Square loan is in their best interest, then have them do that. Even if you don't make a dime, it doesn't matter. I talk about PayPal and Square all the time, and we don't make a dime. We try to tell our clients to get PayPal and Square and advise them to get that kind of financing, and we don't make a dime because it's what's in their best interest. And when they know that what you have is in their best interest, then trust me, they're going to come back to you. They're going to refer, the money will come, but you need to know about the kind of financing that won't pay you a dime, but that will still help them. And grants is one of those ways to get it. Grantwatch.com is a great source for that. Crowdfunding. Crowdfunding is not going to work for every business. If you're a real estate investor, this isn't going to work for you because you have to have a unique idea, something that's rare, something that's different, something that people don't often see. And with that, that's what makes it where you actually get funding for crowdfunding campaign. And you should have donors lined up before you start the project, and you should have a big social network or the ability to share the project or to share the crowdfunding campaign with people that have big social networks, because with crowdfunding, having a unique idea that's really different that people haven't seen, having a huge network to spread the campaign once it goes live, and having donors that are all ready to donate money to show a bunch of activity. So places like Kickstarter see it as a project and actually start showing it and favoring it is what you really need to make any of these kind of campaigns work. Micro loans, microenterpriseworks.org, great place to go. A lot of big deal. Micro loans have really popped up a lot in the last 5 years. Loans under 30 grand were great for startups. SBA even offers micro loans now, not through banks, but themselves, which is the first kind of financing I've seen that they really offer. The rest of the financing they guarantee they don't offer. So micro loans are a great way for businesses to get under 35 grand from places like SBA or Micro Enterprise Works. But again, these are not things that are necessarily going to pay you. It's just something that can help the borrowers. So remember, cash flow credit collateral, that's what it all comes down to. You have one of the C's, you get money. You have 2 of the C's, you get more money at better terms. You have 3 of the C's, you're getting an SBA loan. The goal for us has to be to graduate our customers from 1 C to all C's. That's our goal. Our goal is to get the customer the most amount of money at the best terms. Okay, that's what's in their best interest. We do that by helping them get all 3 C's. We do that by helping them get the other 2 they're missing. If they have credit issues, we get them to a reputable credit repair company to fix the inaccurate information that shouldn't be on their credit report to begin with and rebuild. If they've got cash flow where they're not showing profits on tax returns, we need to let them know the importance of showing profits on tax returns and how that opens up SBA loans and term loans and lines of credit and so many other things. If they don't have cash flow, let's get them the financing using credit, collateral, or business credit so they can get the money they need to get the business off the ground and start producing cash flow. Let's solve that problem. If they don't have collateral, let's teach them about the importance of things like account receivables, where they can let their people pay on terms and build an asset that helps them get money. By doing this, we can then help them graduate just from one type of financing based on credit, like unsecured credit lines that we talked about. Then we help them get the money they need to produce the revenue, and they start producing cash flow. We teach them the importance of tax returns. Now we're getting them revenue financing. Then they get tax returns. Then we've graduated them to term loans. Then we help them understand that they can accept payments from customers, and they can now do so because we got them money through unsecured credit lines and through cash flow financing, even term loans. Now they can let their people pay them on terms. They can start accumulating account receivables or inventory. Then they have that third C. Then we can graduate them to SBA loans. This is our goal. We got to graduate people to the best financing, and that's how we do it. We get them the money based on one strength. We help them understand the missing strengths and what they need to do to get more of those C's, all the way to where they graduate to an SBA loan because they have cash flow, credit, and collateral. That is the goal. So not a lot of things here today to go over regarding credit-based financing. The main things you need to know is if somebody has a 650 score, they can usually get 5 times or more the amount of their highest credit limit through these 0% credit lines that they could take cash out on. Even their consumer credit cards, they can't take cash out on. Okay, if they have 680, 700 plus credit, then they can come in and they can get the 0% business credit building accounts, build high limit business credit accounts, and get up to 150,000 in financing. For both of those, guarantors are welcome. And let's never forget about business credit, where they don't need cash flow credit or collateral. They don't need good consumer credit. They can build a credit profile from inception of the business and then use that or established credit profile for the business to basically fund itself, to get subsequent high limit accounts. So with those 3 options, we pretty much just help everybody, because we can help the startups and we can also help everybody that doesn't have any of the C's with business credit as well. And then of course, don't forget about the term loans. Don't forget about the SBA loans. Don't forget about the SBA cap lines and peer-to-peer lending, which starts to become available with somebody that has 650 on average plus credit scores. And then of course, the epitome of what we all want, which is the SBA loan, which is going to require the good credit and the cash flow and the collateral. And that is how we get people approved for financing. So if you have any questions, go ahead and type them in right now. I want to make sure that those are answered. So next week, we're going to go every bit of an hour, because we've got a lot of financing to jump into when we talk about the third C, which is collateral-based financing, and how somebody can use assets like equipment, inventory, real estate, account receivables, purchase orders, and many other forms to actually get financing that's lower interest rates than SBA loans. So that's something you're going to want to tune in for, because as brokers, there's a lot of money. Being that we're helping people get financing, there's a lot of money to be made on some of that kind of financing for you, but most importantly for your customers, there's some really low rate financing, cheap financing, in more ways, even if they don't have cash flow credit or collateral, to tap into assets of a guarantor or somebody that does, and use those to fund the business. So we're going to be talking about a lot of that stuff next week as we open this up and do more. Can a startup, and here's a question from Ralph, can a startup get SBA without cash flow? There is a possibility they can get micro loans, yes. But even then, they're going to want to have some cash flow. SBA is going to want to see that they have the income to cover the debt. Remember, everybody, that's all that lenders really care about. There's only one thing they ever really care about. Can you pay back the money? That's all they care about. So they're going to verify that the person has enough income to pay back that actual micro loan, and they're going to want to see the business have some kind of revenue. But an actual SBA loan cannot be obtained, because as we talked about, you've got to have collateral, cash flow, and good credit, and they're going to ask for 2 to 3 years worth of tax returns. So a startup won't have 2 to 3 year tax returns and automatically is excluded from every SBA loan, or pretty much every kind of financing that a big bank would offer. Bank of America, Chase, those conventional banks are pretty much out at that point, although some micro loans may work in that scenario. So hopefully that answers that question, Ralph. Another questions, I'm going to wrap this up. If you have any other questions, reach out and let us know. Again, not going to draw this out because you got the main points here, but next week we will go probably every bit of an hour because we have a lot of different kind of financing as we dive into, as we talk about the actual asset and collateral based funding products there. So I look forward to seeing you all then. Anything else we can help you with along the way, reach out to us and let us know. And don't forget, over 1,000 lenders. We have like, I don't know, like 40, 45 now loan programs now that we can help with. So this gives the borrowers the best chance of getting the most amount of money. By putting together all finance sources in one place, we have Suzanne, who all she does is goes and gets us the newest, best lenders that we can work with. So with all the access to lenders and programs, it helps us get the most money for our borrowers, which of course makes them happy, gets the most referrals for you, et cetera, and gets them to come back and get more funding again and again. And that's really the key to success. If you want long-term success with helping people get financing, it comes down to making sure they're happy. And that comes down to getting them the most money, getting it for them at the best terms, so they come back again and again and they refer. And that's only possible if you're working within all three of the C's. You're offering cash flow based finance, you're offering credit based financing, you're offering collateral based financing, because that's what will get somebody the most money at the best terms. And then we've got to be conscious to graduate people to the next level to constantly help them keep getting more money at better terms, so then that way they can get to that SBA loan where they have stable long-term money they can get whenever they need it. That's really the key. Any other questions you have along the way, reach out to us and let us know. We are here to help you with this. And don't forget, in your back office, you have access to marketing videos, marketing flyers. You have access to all different types of a funding program cheat sheet that gives you every funding program and gives you little cheat sheet of information on what's available, or how that program works, things you need to know, rates, terms, etc. Everything you need to offer business credit and financing, and the funding, the emails that promote business credit financing, all of that's in your back office. So you have all the resources you need to promote financing out to the general public. So anything that we can do to help on our end, reach out to us, everybody, and let us know. And I look forward to seeing you next week when we dive into the third C, which is collateral-based financing. Thanks, everybody. Have a great day.